Most people don't fail at investing because they lack money. They fail because they lack knowledge. If words like stocks, bonds, and mutual funds sound confusing or intimidating, you're not alone. Many people want to invest but don't know where to start, and that confusion keeps them stuck. In this video, I'll explain what stocks, bonds, and mutual funds really are, how they work, and the smartest way to start investing, even if you're a complete beginner. If this is your first time watching the channel, don't forget to subscribe for more practical financial advice and smart money tips for 2026. Let's get into it. A stock represents ownership in a company. When you buy a stock, you're buying a small piece of that business. If the company grows, becomes more profitable, and increases in value, your stock also becomes more valuable. That's how investors build wealth over time. Here's a simple example. Imagine a company is worth 1 million naira and divides its value into 1,000 shares. Each share represents a fraction of that company. When you buy one share, you become a part owner. So how do you earn from stocks? There are two main ways to make money from stocks. The first is price appreciation. This happens when the value of the stock increases over time. The second is dividends. Some companies share part of their profits with shareholders as regular payments. Stocks are powerful because they allow your money to grow with successful businesses. Over the long term, stocks have historically delivered higher returns than most other investments. However, stocks also come with risk. Prices can rise and fall daily. In the short term, you can experience losses. That's why stocks are best suited for people who can stay patient, think long term, and avoid emotional decisions. Now let's talk about bonds. A bond is essentially a loan. When you buy a bond, you are lending your money to a government or a company, and in return, they agree to pay you interest and repay your original money after a specific period. For example, if you buy a government bond worth 100,000 naira at a fixed interest rate, you'll receive regular interest payments. At the end of the bond's term, you get your original investment back. Bonds are considered more stable than stocks. They provide predictable income and are less volatile. That makes them attractive to investors who want safety and steady returns. The downside is that bonds usually offer lower returns compared to stocks, especially over long periods. They may also struggle to keep up with inflation. In simple terms, bonds focus more on preserving wealth, while stocks focus on growing wealth. Now let's bring everything together with mutual funds. A mutual fund pools money from many investors and uses that money to invest in a diversified mix of stocks, bonds, or both, and these investments are managed by professional fund managers. Instead of choosing individual stocks or bonds yourself, you're investing in a ready-made portfolio. Think of it like this. Rather than buying one fruit, you're buying a basket containing many different fruits. If one performs poorly, others can balance it out. There are different types of mutual funds. Some invest mostly in stocks, some focus on bonds, and others combine both to balance growth and stability. Mutual funds are popular with beginners because they offer diversification, professional management, and simplicity. You don't need deep market knowledge to get started. However, mutual funds charge management fees, and you have less control over specific investments compared to owning individual stocks. Still, for many people, mutual funds are one of the easiest and safest ways to begin investing. So, how do stocks, bonds, and mutual funds compare? Stocks carry higher risk but offer higher potential returns. They are ideal for long-term growth. Bonds carry lower risk and provide stable income, making them suitable for conservative investors. Mutual funds fall in between, offering a balance of risk and return through diversification. There is no single best investment. The right choice depends on your goals, time horizon, and tolerance for risk. Now let's talk about the best way to start investing. First, start with education. Never invest in something you don't understand. Knowledge protects your money. Second, start small. You don't need a large amount of money to begin. What matters most is consistency. Investing small amounts regularly is far more powerful than waiting to invest big sums later. Third, choose reliable platforms. Use regulated brokers, trusted investment apps, or established fund managers available in your country. Fourth, diversify your investments. Don't put all your money in one place. Spread your risk across different assets. And finally, think long-term. Wealth is built over years, not days. Short-term market movements don't matter as much as staying invested and disciplined. Time in the market is more important than trying to time the market. To wrap up, stocks allow you to own businesses and benefit from growth. Bonds provide stability and predictable income. Mutual funds offer diversification and simplicity. The most important step is not choosing the perfect investment, it's starting early and staying consistent. If you found this video helpful, like it, share it with someone who wants to learn about investing, and subscribe for more content on financial education and wealth building. I'll see you in the next video.